Two quality stocks to buy in December of 2024. This is a video that I do every month talking about two quality stocks or two stocks to buy. And I have to admit, it hasn't been easy to find quality stocks trading not at a fair price, but at a cheap kind of price, at an undervalued price. It hasn't been easy with the S&P being up 27% and everything being up so much. I'm not finding a lot of buying opportunities. I'm putting a lot of price alerts in case the market goes down. This way I'm prepared. I talked about it in another one, but I'm not seeing the best buying opportunities. However, I did find those two stocks. The first one is a very interesting one. The insiders, the CEOs, they've been loading up like never before, and the stock doesn't care and it's still going down. So this one is a very interesting one. The second one, you might have never even heard of the company. Maybe you don't know it exists, but it's providing a mixture, a very rare mixture of amazing quality, moat, competitive advantage, pricing power for a very low price of 13 times earnings, and it doesn't happen very often. So I really hope you enjoy it. But before I get into the first pick, I'm just gonna give an honorable mention or just a shout out to Google, because Google is really, in my opinion, the best kind of price for quality in the market, down 2% over the last 6 months. Uncertainties from the antitrust lawsuit. I did a deep dive over here if you're interested, but you're still getting the company, amazing company. You're getting good cloud in many different pieces for amazing margins, amazing balance sheet, wide moat company at 19 times earnings. This is very cheap, 19 times earnings. And if you look at this line that I'm showing you, 19 times earnings has historically been an amazing time to be buying Google. And I don't believe this time is different. And even though the company is a couple $1 trillion kind of market cap, is still growing earnings per share 12, 13, 15, 16%. And you're getting all that stuff at 19 times. It's very cheap. This is something that Barron's did where they valued Google in separate kind of pieces. And they found out that Google search alone is worth $143 per share. YouTube alone is worth $65 per share. So for the current price, you're getting search plus YouTube plus like $20 worth of cash per share, maybe a little bit more than $20 cash per share. And you're getting cloud, Google Cloud, and Waymo for free. And this is how cheap the stock is. Like, people talk about ChatGPT and all these things, but sometimes it's not what you buy, it's how much you're paying for what you buy. And Google is starting to get to a level where it just doesn't make sense. Like, even if ChatGPT takes over sometime in search, you still have YouTube, you still have other things that are worth a lot of money. And if Google ever decides to split Waymo, which is a leader in autonomous driving, autonomous taxis, especially in California, they're expanding with Uber in different states. This alone could command a few $100 billion market cap in the hyped up market that we have right now. And it could unlock amazing value for shareholders. So if you compare Google to any stock, Google, in my opinion, is the best price for quality in the market. But I'm gonna get started in the two stocks. The first one is LVMH. A lot of you know it. It's a very popular company, down 21.5% year to date. The first reason why it's down is because they've been suffering on organic growth and growth in general, because it hasn't been the best market for things you really don't need. It's been a good market for things you want. Look at Walmart, look at other things. But people don't have the kind of disposable income they used to have before, and they're cutting back on some of the premium, or you could call them maybe luxury items. But LVMH has been holding up better than, Dior, and better than Kering, which owns Gucci, and all those brands have been suffering, but LVMH has been holding up a little bit better. And you also have potential tariffs from United States on Europe and other things. This is another concern. But a lot of you know LVMH. They own amazing, high quality brands, premium, or even some luxury brands. You call them luxury, I guess. But they own a lot of popular brands that a lot of you guys are familiar with. And what's very interesting about the stock is the CEO, Bernard Arnault. He's been loading up on LVMH, and he doesn't do it very often. Last week alone, he added 22 million. Over this month, he bought $78 million worth of shares. $78 million. I don't care if you like or hate the product or you hate the CEO, but if you have a CEO that's buying $78 million, you have to pay attention. You have to try to find out, why is he buying $78 million worth of LVMH at this price? Maybe he believes things are going to start getting better for the luxury market, or maybe he believes that even if things are slow, LVMH is getting to a point where it's just a lot of bad stuff stuff is priced in. And he's buying 78 million. The stock isn't reacting too much, which is very interesting. 78 million. That's a lot of money at this price. And if you look at the last 9 months of revenue, it hasn't been the best. Total, they decreased 2% due to currency effects and other things. And this is not good. It's not good at all. But compared to other kind of premium or luxury brands, LVMH is still holding up better. And 2025 will look much better on a comp basis on 2024 because we compare year on year. So 2025 is going to be easier for them to beat on comps versus 2024. If you look at growth in terms of other countries, it's been terrible. US barely 1%, Japan up 36%. It's been a beast over there, also due to the currency and other stuff. Asia decreased 12%, excluding Japan, which is mainly China. They've been killing them. But now the government is trying to stimulate. So this is another potential tailwind for the company. Is, you know, Europe and other places having lower interest rates, and maybe it's better for some people. But also it's a stimulus stuff in China bottoming out, and people start buying that stuff again. All those stuff are amazing tailwinds for a company like LVMH. But LVMH right now is trading at 20 times earnings. And if you look at this line that I'm showing you, 20 times earnings has historically been an amazing time to be buying LVMH. And this is when I first bought LVMH in January. I bought it around 19 times earnings. Then the stock went to 27 times. It went up, I believe, 28% in 3 months when I owned it. Then I looked at it, it didn't make sense, so I sold the stock. Now it's back at a very interesting level. The cheapest it went to was 16, as high as 40, and now you could buy it for 20 times earnings. Now, I know a lot of you will say, yeah, but 20 times earnings isn't cheap for a company that's not declining, and that's declining in terms of revenue growth. And trust me, I used to saying the same thing. I used to believe the same thing. But the truth is, and what I learned the hard way, is that those kind of quality companies, they very rarely look cheap whenever they're bottoming out. Like if you look at a market crash, Visa is not going to 15 times earnings. You could dream about it all you want. It's not going to 15 times. SPGI, S&P Global, another one I missed on. It's not going to 18 times earnings. And the market is forward looking. So maybe it believes LVMH will grow more in the future. So it's not trading based on that it's declining today, but it's trading more on the quality on the business and what it could deliver in the future. And this is my valuation model on LVMH. I put in 7% revenue growth, which I believe 7% is fair. It's been all over the place after COVID, but it's expected to be 6 to 7%. So I put in an average of 7%. I believe that's fair. Net income margin is 17%. I kept it at 17%. PE ratio 20 times right now. I'm expecting it to get back to the mean of 24 times earnings over the next 5 years, once the whole tariff stuff are settled with, once the economy expands again in most countries. 24 times earnings isn't unreasonable for LVMH. So I'm pricing in 24 times earnings and a 3% shareholder yield, which is a 2.5% dividend and 0.5% in buybacks. This has been a historical trend. In total, I'm getting 78% on the upside, or 13.3% CAGR. And I have to admit, 13.3% CAGR for a mega cap company like LVMH, for such amazing brands and good CEO and all these things, and the CEO buying, and I believe the upside in the short term, once the tariff stuff and other stuff clears up, the upside is much more than 13%. Could be maybe what I made, 25, 28% in 3 months. It does happen when you have a change in sentiment, especially in China and other things. But 13.3% isn't bad at all for a mega cap company like LVMH. So I like LVMH over here. I think the short term is likely going to look much better than 13.3% CAGR. And the CEO is buying $78 million. So I like it very much. And that's why I put up LVMH as my first pick for the month. The second one, which maybe some of you don't even know it exists. And this is a company called KOF, or Coca-Cola FEMSA. I'm going to explain how it's different from the parent company, which is Coca-Cola. It's down 14% year to date. Over the last year, down 6%. And if you're trying to get familiar with the business model, I would recommend watching this Monish Pabrai video if you have time. Coca-Cola, just type it in. It explains to you how Coca-Cola's bottlers are different from the business itself, which is Coca-Cola, and it's an amazing one. And KOF is basically a Coke bottler. Coca-Cola, the company itself, does not set the price of the Coke cans that you buy at the store. The bottlers are the one that do the packaging, do all that stuff, and they are the one that sets the price of the Coke can that you buy at the store. Coca-Cola sets the price of syrups. That's why they have such high margins. Everything else the bottlers do, but Coke sets the price of syrup that's used to make the Coke products and other things. And that's why it's such an amazing business model. But if you're a Coke bottler like Coca-Cola FEMSA, you have an indestructible business model, an indestructible kind of mode. You just start a company, start distribution centers, buy trucks, and then go to Coca-Cola and then take over their current bottlers. Like that just doesn't happen. So you have amazing pricing power, an amazing business model with such a relationship that's indestructible, and it's amazing. And Coca-Cola is located in Mexico, and KOF is in Mexico, and it's in Central and South America. And the stock has been struggling mainly because of the Mexican ETF. It's been getting killed, down 24% year to date. The Mexican peso is a currency, although it looks like it could be bottoming out, it's also been getting killed from a much stronger dollar, and it's getting to a very interesting level. The company is an amazing company, and it's been declining mainly due to stuff that's not related with the company. And that's why I've been finding some value in Mexico. If you could take some pain, and if you could have some patience, 3 to 5 years, you could find a lot of stocks I'm finding, 10, 13, 15 times earnings. Some of them are owned by 50 or 60% of the same company in US. They own 60% of the Mexican company. So it's an amazing proposition if you have some risk tolerance, and if you could wait on it a little bit. And also been going down again due to the presidents there. They have a new president, all that stuff, and we don't know what kind of things could happen. But they're getting cheap, and this is not China, it's not Russia. That's what I believe. That's why I own a Mexican stock. And if they keep going down, I'm gonna buy Coca-Cola FEMSA, which is why I'm talking about it in this video. But Coca-Cola FEMSA serves 272 million people in Central and in South America. They have 252 distribution centers, 11,457 trucks. And the best part about it is they have increasing volumes. This is something that almost no other company has in the beverages space and other things. Most beverage companies like Coke, Pepsi, even Mondelez and other kind of snacks and other products, they all have decreasing volumes. They have declining volumes. That's why they hike prices so much, so they could offset the declining volume. But FEMSA in Central and South America, they have good demographics, and they actually been increasing in volume. So you don't only have an increase in volume, but you also have pricing power, and you have both. You have price hikes and you have an increase in volume. You have a double effect, and that's something you don't find very often. And you're finding it with this company, Coca-Cola FEMSA, and you could see it for the first 9 months so far for this year. Volume is up 5.1%. It's very rare. Revenues up 12.4%, gross profit up 14%, operating income up 13.4%. So it's been looking much, much better for the company. And you're getting this company with increasing volumes, 12-13% revenue growth, earnings per share growth has been growing too, expanding gross profit margins, wide moat, impossible to replicate, is trading at 13.5 times earnings. This is absolutely insane. The lowest it went to was 11.6 times, as high as 29 times, and now it's trading at 13.5 times. Other comparables in other countries, even in the US, they trade at 20 times, 22 times, because of the moat, because of the pricing power, because of just an amazing setup that's impossible to replicate. And you have Coca-Cola FEMSA at 13.5 times earnings. This is very cheap, or an 8% free cash flow yield. Worst case, you're getting that 8% free cash flow yield. Earnings per share is still growing. This year, it wasn't the best at 5%, but it's been growing 10, expected 13, 10%. So 10% earnings per share growth, 13.5 times earnings, 8% free cash flow yield, 272 million people and good demographics, increasing volumes. And it's something you don't find very often. And it's not for everyone. Like if you're willing to be patient, if you're willing to take some volatility, if you're willing to sit on some short-term losses, leave it for 3 to 5 years, the reward could be tremendous. Because again, I believe what's happening in Mexico it's not like the next Alibaba in China. It's not the next whatever happened to the Russian stock. Like this is different. That's what I believe. And that's why I own one Mexican stock. And if they keep going down, I'm going to buy more, and I'm going to buy Coca-Cola FEMSA. So I'm finding a lot of value there. And I talked about LVMH, Google, Coca-Cola, FEMSA. Those are my 3 stocks for December of 2024. And I share everything I do, everything I buy in my group if you're interested. So this was my video, not financial advice. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.